you're brand new to this, you've never looked at the stock market before, you can commit £100 a month into the stock market, but it freaks you out, you've never done it before, and you don't know where to start. This is exactly what I would do with £100 a month. Welcome back to the channel, guys. If you're new to the channel, you've never seen any of my videos before you go any further, pop down and just click the subscribe button so you don't miss any new videos that come out. And while you're down there, give the video a little like as well, because it really helps the content, helps it get out there to more people. Or wait until you've watched the video, liked the content, like what I have to say, and then like it. As with the intro, we're going to go through exactly where I would put £100 a month. If I could commit £100 a month into the stock market, this is what I would be putting it into, providing you're looking for something relatively safe, a small return on your capital, and maybe something a bit growthy or something with a little bit of growth in it as well. We're going to separate that £100 and we're going to put it probably into maybe 3 or 4 different things, and you can obviously decide exactly what you put yours into, but I'm going to show you what I would be putting my money into if I had £100. I certainly was doing a very similar thing, but with a larger sum of money. I was just taking X amount of money and splitting it and going, I'm going to buy some of that, and some of that. I changed my strategy more recently because I've built the portfolio. I wanted to go more income based, but this is what I was doing with my money for a long time. So this should give you an idea of a good place to be putting your money, a good place to be diversifying your money into the stock market for a little bit of capital return, a little bit of growth maybe, and something that should be safe as houses. So we'll jump into the portfolio. We'll go through the positions because all of the ones I want to talk about I am already involved in. So I have positions in these stocks, funds, and we can go through what return you'll get on your capital if you're putting money into them, and what that return may look like over the course of very many years in the form of a compound interest calculator, which is my favorite thing to do. So let's jump in there and do that now. Yet again, and as always, we're starting in the portfolio, but this isn't the portfolio we're going to look in, because when you've got £100 a month, you are not going to be able to invest or trade really on the IG platform. Not going to benefit you in any way, because you'll have to pay commission on what you're buying, which ends up being quite a lot, because you won't have enough money to buy and trade 3 times in a month, because you need to be spending at least £90, dollars or euros in every one transaction, and if you've got £100 to spend, figures just don't add up. So you're not going to be investing in IG, which is my favorite broker, but instead you're going to be going on to Trading 212, which I have a portfolio with as well, or 2 portfolios. So this one we're going to look at the positions I'm in, because I am in a few of the ones that would be beneficial to you as a first time investor. Let's get straight to it and start breaking down what we're going to be investing in. So you're going to take your £100, well, no, you're not going to be. This is what I would do. I would break down your £100 if it was me, and I would allocate £60 of that into some sort of ETF, which is an exchange traded fund. An ETF, very much like the one you're looking at on screen by Vanguard, like the S&P 500 ETF, is simply a collection of stocks that a company like Vanguard invests for you, diversifies your money for you into a fund that is then managed by said company. So if you go onto the Vanguard website, we have a list of all the funds they have to offer, which is a lot. Now, what I would suggest is you put the money into something that you know. Now, you've got the option of doing UK funds, following the FTSE 100, following the FTSE 250, which is the top 100 and top 250 companies in the UK, one's large cap, one's mid cap. You can follow the Japanese market, you can follow the American market. Now, the one I invest in is this one here, the Vanguard. If you look at the top of my portfolio, the Vanguard S&P 500 ETF. It's also this one here in Trading 212. Trading 212 doesn't charge commission and fees, so you can put and we'll do fractional shares. So you can put your £60 to work into a Vanguard S&P 500 ETF. This will diversify your money for you. Let me give you a quick look at what the Standard & Poor 500 top companies in the US typically has done over time. You can see that illustration there. That should give you enough kind of to go on. The last 5 years it's done nothing but go up, apart from early 2020, and we all know what happened. So that's the first thing you do. They would diversify the money for you. It's a fund that is managed. They are the professionals. and they basically just track the S&P 500. The UK ones, which are up here, they will track the FTSE 100 and the FTSE 250. You can go to the Japanese market. You can even go, I've got one in my IG account, which is the Vanguard Total Stock Market Index Fund. So rather than the top 500 companies in the US, it actually invests in just over 3,000 companies for you. So it really diversifies your money for you across all sectors of the stock market. That's the first thing I would do, and that would be around £60. You're then left with £40. I'm going to split that in two. So what I would do there, if it was me and my money, which I was doing for a very long time, and I go back into Trading 212, let's go on to the income section, the dividend paying section, where you're going to get almost guaranteed return on your capital, or very good return on your capital. Something like Ultra Group. Now, I'm in Ultra Group. Ultra Group is traditionally a tobacco company and have been around for very, very many years, and have now started to diversify into lots of other things like e-cigarettes and bits and pieces. They are evolving, which is really, really good to see. And I have their dividend scorecard up here. Now, this is the part which is probably less safe when putting your money into, which is why we're only doing £20. 20% of your allocation is going into something like Ultra Group. The reason being, it's one stock. If Ultra Group suddenly collapses and goes down the pan, you pretty much lost your money. So that's the risk. But a company like this that's been around for so long, let's have a look at their dividend history as well, just to show you what kind of return on your capital you might be getting, just to show you, I guess, how potentially safe the return on your capital is. Don't forget, there's no guaranteed return on capital, there's no guaranteed income. You could lose your job tomorrow, and then you've got no income. So there is no guarantee in life. But if you have a look at the dividend scorecard here, it's got a 7.5% yield. It's got a payout ratio of 78, so it's still got 22% of its profits hopefully being reinvested back into the company. And it's grown its dividend for the last 52 years, which makes it a dividend king. I would argue if a company's been paying its dividends to its shareholders for the last 52 years, it's relatively safe. It's probably been paying its dividends to its shareholders longer than most people have held down a job. That makes sense? Would you be able to argue that? Can you argue that? Pop down in the comments if you have a retort to that. But the fact is, it's been paying for 52 years. Not many employers pay one person for 52 years. I'm sure some of them do, but not many. So investing in the stock market is risky. Yeah, so it's having a job, actually, and having an employer that's going to guarantee paying you. Don't forget, these companies, if they go down the pan, what happens if you worked for Ultra Group and that was your income and they went down the pan? You still got no money coming in. So anyway, so we're going to look at dividend history. It has obviously a very long history. If we go max, it's been paying since, oh crikey, a really long time, and grown their dividend for a very long time as well. So that would be my income play. You can go in all sorts. You can go to Ultra Group, you can go to AS Capital. They've been paying for quite a long time, or very long time. As commercial real estate, enterprise products partners, probably slightly more risky. Companies like Visor, Royal Dutch Shell's been paying from yonks. Lots of these companies have been paying, Coca-Cola's a classic, dividends for a very long time. But I would be going into a high dividend yielding company instead of something like your Procter & Gamble that pays kind of 3.5%. That 20%, I would take the risk, go high yield, go 7 or 8%, 9, 10% even. In my main portfolio, I've got loads of them. I've got AGNC, high dividend paying, PIMCO, high dividend paying. Those two are monthly payers as well. Fantastic options for you as well, because then you get that drip feed every single month without fail. Anyway, high income, high yielding. That's where I put £20 of that 100. The last £20, I would be going into something like, if it were me, Apple. This is my growth. So I have taken some money out of Apple actually more recently, but I still have a reasonable amount in there. And Apple, in my eyes, have only ever done and will only ever do really one thing with minor corrections along the way. In which case, minor corrections are great. I'd be buying in these minor corrections. I would be buying, and I have been buying in these minor corrections. Now you've got options. Am I in anything else in this portfolio that would be high growth? IBM, maybe. You've got Microsoft. You've got Apple. You've got maybe Tesla, but that's probably a bit more speculative because you just don't know what Elon Musk is about to do. But any of these would be would be high growth, your Apple, your Microsoft, maybe your IBM, your Tesla, things like that. And I would be just drip feeding in £20 each month and just see what it might do. Now, with the high growth one, you can pick something that you think will be great in the future. It can be slightly more speculative or something that's got promise, and just drip feed into it. Don't forget, you don't have to stick to one thing. You could drip feed into Apple for 6 months, change your mind and start drip feeding into Microsoft just in case Bill Gates suddenly comes out with the next best thing. It's entirely up to you how you do it and who you go into, but the allocation for me would be 60% ETF, diversify, safe as houses really is. 20% income, high yielding, 20% high growth, maybe speculative, but something that is here to stay. Your Apples, your Microsofts. So that's where I would allocate the money. Let me just take you to a compound interest calculator and I'll run you through what this might mean to you in the future. So if I take pounds, 100 initial balance, it doesn't matter, initial balance 0, yearly interest rate, you get good return on the stock market. Let's go, they say between 8 and 10% yearly in the stock market. Don't forget, you've got some growth in there, that should be more. You've got some high yielding ones that won't be as much probably in terms of growth, and you've got the general stock market. So let's just go 9 in between that 8 and 10. And let's say, for example, you're 25 years old. You know who this video is for. 25 years old and you want to retire at 60. That gives you 35 years of paying into this fund and watching it grow. We'll keep the compound yearly and you're going to deposit every single month £100. Doesn't matter what point in the period, I don't think. And let's not increase the deposits yearly due to inflation. Inflation is huge, which means you're going to be spending more money on buying things and have less money to invest. So let's just leave that the same. The hope is that wages go up at the same rate, but they don't. So let's just leave that the same. It's just £100 a month for the next 35 years. Don't forget, in 35 years, your wages will be much higher and you can commit £200 a month. But then everything's going to cost more as well. So let's just leave that as it is and just go calculate. It'll give you an idea of what you'll be left with in 35 years when you retire. This is not going to be as staggering as you might think, but it should be pretty good figures. They are pretty good figures in order to encourage you to start doing it. So your end figure ends up being 269,530. You have contributed 42,000 of that over that 35 years, and the stock market has done the rest. Now don't forget that between 8 and 10% is stock market only. 20% of that, you're getting that drip feed of a high income, a high yielding stock as well. So that should be higher. But this is simply just market growth. Have a play around with a compound interest calculator if you can, if you want to. So if you went £125 a month and you can commit that extra 25 quid because you just had a little bit of a pay rise maybe, and calculate that, the figures should be pretty amazing, or the difference should be pretty amazing just for an extra £25 a month. You end up with 336,900. So as I said, have a little play around with that. Compound interest calculators are the most fun thing, and you can really truly begin to calculate future wealth. Just as a prime example, I spoke to someone the other day that said, oh, you said you were going to be a millionaire. I said, well, it's pretty much inevitable because I'm 32 now, so I'm going to be retiring in 28 years, and my initial balance as it stands is currently, well, it will be 40,000 in the stock market, because I need to take a bit more out, but again, that's another video. And I'm currently committing at least 1,000 into the stock market. So if I calculate that and just drip feed into the stock market and commit to it, my end balance is 1,858,223.45p. So you can't not. You can't not be a millionaire. It's inevitable. Plus, you then got property growth if you're involved in property and other bits and pieces. You know, so play around with these calculators. It's absolutely inevitable not to become a millionaire if you start early enough and you can commit enough into the stock market. I could do this all day. Let's say you have some fantastic years and it ends up being 12%, and I end up being able to commit because I get pay rises £1,200 in the stock market. Calculate that, and in 28 years when I'm 60 and I want to retire, I'll be retiring on 3,852,000. Play with one of these calculators, commit a certain amount to the stock market, allocate that amount to the stock market as you see fit. But if you're just starting out and it spooks you, £20 a month is not a lot to go into a high risk growth play. £20 is not a lot to go into a single company that pays a high dividend to get that yield, and £60 is not a lot to be putting into an ETF of some description to get that overall market coverage. That has been so long, and I'm so sorry, and you're going to be so bored, but I don't care because I could go on about this literally for so long. It's so important that people invest their money. I mean, look at those figures, look at the figures. 3.852 million, and I'm going to go into some high risk stuff, maybe that is high growth, huge yields as well. So, and if I can commit 1200 by the time I'm 60, there's no way I'm not gonna have like 3 million quid in the bank. Anyway, I'll sit through in here and I'll do the outro. So that's where I put my money. Hopefully that was helpful for a lot of you new investors. Maybe not, and you want to do a completely different thing. That's absolutely fine. Find something relatively high-ish yielding, find a fund that kind of diversifies your money for you, and find something else that is growthy, and that should look pretty good for you. Or don't take any of my advice and just go all growth, all income, or all full diversification in the form of an ETF, full stock market ETF or something like that. So totally up to you what you do with your money. Just showing you what I would do, and certainly was doing with my money when I wanted something pretty safe but covered all bases. So I'll wrap that up there. If you have enjoyed the video and you've got something from this and this has been valuable to you, don't forget to like the video because it really does help it. Pop a comment down below what you're getting into and whether that was helpful, or what your picks would be if they're not those, and subscribe to the channel so you don't miss a video. So I'll catch you guys in the next video. See you later.